Welcome to the Southeast Retirement Planners Podcast, where we will go beyond the balance sheet with our guests, not only to share from our personal experience as financial advisors of over 25 plus years, but also to learn from our guests about the issues and topics that are important to them. Our firm specializes in taking care of the financial plans for individuals and small businesses by helping our clients identify their individual goals and taking a conservative and ongoing approach to helping accomplish them. We are located in Hickory, North Carolina, and look forward to continuing to serve our clients and our community. Thank you for joining us. We hope you enjoyed this week's episode.
Hello and welcome. I'm Ryan Edwards, and this is Les Stewart, part of the Southeast Retirement Planners, and we'd like to welcome you to today's Southeast Retirement Planners podcast. Today's topic, we're going to be talking about some questions to ask a financial advisor when considering their services, and I think we have a few good questions for everyone to kind of learn from and draw some information from. But before we get started, just wanted to cover a few things to get you to know us a little bit better. In our firm, we're located here in Hickory, North Carolina, where we're filming it today, and you can check us out online at our website, www.seretirementplanners.com. Yes. And on there you can find out about us, the services we provide, as well as past recordings of podcasts that we've had, and anything from market commentary to calculators to.
There's more information than you want.
Yeah, probably so in one visit. But
you can also communicate with us through there too.
Exactly.
If you can't remember our phone number.
Exactly. You can find us through there, and you can for our clients, you can use that as a resource to log in and view your accounts as well. So it's has a bunch of information on it. And one of the items that's on there as well is under the Make a Plan tab is our software we like to use quite a bit. It's Asset Map. And so underneath Map Your Plan, it'll pop up Asset Map, or you can click on the QR code by running your camera over this QR code here. It'll take you to a link, and it'll start. It's a great resource that we've used for a number of our clients that aggregates everything into one picture, everything financially for you.
Yeah, it's a great way to start your plan for your personal, your personal plan that you're trying to put together. It's a great start.
And that's from not only individuals that are young, trying to start out, but also those pre-retirees and retirees. It's a great resource to let one spouse that may be the one that's the caretaker of the finances in the household. It's a great backup for the one that if God forbid something were to happen.
Sure, and good inventory of everything you have.
Exactly, on one page. So we're happy to be able to be here today, and think that this is going to shed some light on some major topics that come up. And one of the biggest things, the questions, if you think you're exploring a relationship with a traditional financial advisor, some of these questions are things to consider. And one is, are you a fiduciary? It would be a good one to ask. It's a very important. It's a that word is being used a lot more. You hear it in commercials. But let's tell us kind of a little bit about what a fiduciary, what they do.
Well, a fiduciary is there to serve your interests and to make sure that what they're doing is right for you and not necessarily something that's right for them. To me, that's the kind of the simplest way to say it. But, the difference between advisors that are out there, and there's nothing wrong with advisors that aren't fiduciary if that's what fits what you're trying to accomplish. But, the traditional stockbroker that when you see the 80s movies and that kind of thing, those guys are not fiduciaries. They're trying to put you in a financial product. Now they may be, in the back of their head thinking this would be a good investment for you, but they're not analyzing your situation and trying to do what's best for you. Where a fiduciary, like we are, is we're obligated to, when we recommend a product, to not base that recommendation off of how much that's going to pay us or what our company is having a sales promotion on or something, we are obligated to make sure that fits your investment profile and your long-term goals.
Truly in the best interest of the client. Yeah, so that's a good point. Well, that's a word that's thrown out there quite a bit, but it's very important. And it should go without saying, we think, but nonetheless, it's appropriate to ask.
Right, and all you have to do when you go interview an advisor is ask, are you considered a fiduciary? And you can also look that up through FINRA as well.
On Broker Check, and that's on our website as well, and any reputable firm has that as a resource on their website. And along those lines, it's another question would be, how do you get paid? That you'd ask of a potential advisor, and I know that there can be a variety of different fee structures, right? I mean, and you just mentioned, commissionable or versus advisory, what would be called advisory. So tell us a little bit about a fee only or a fee type advisor.
Yeah, so kind of back to the commission thing. First, that was the old model, and that was really all that was out there. A person bought an investment, a commission was paid up front usually. Could be anywhere from, 1 to, I've heard that it used to be as much as 7%, and that was how the advisor was compensated, and that wasn't even all the fees, and we'll get into that later. But today the fee only model is when usually it's around a 1% to 1.5% fee. I've seen it as high as 2%. But so the advisor is compensated on an ongoing basis, and oftentimes in our model is it's a quarterly fee based on a 1% a year.
So a quarter of 1% every quarter,
and that's on the total amount of money that they manage or we manage, and that's how much the advisor is compensated. Now that number varies depending on your situation and the advisor's scale that they choose to charge. But you and I have talked about that over the years, and we feel like that structure really kind of aligns the goals of the client with the advisor, and as the client's money grows, the advisors.
The only way we make more money is if they make more money.
Right.
Exactly. I think that there's also so therefore that percentage is applied to the assets under management. And there's also another fee structure that's out there. There may be a flat fee for services that's agreed upon up front before the relationship's established, or there could, in some cases, be an hourly fee.
Right, and depending on what service, and that's really, there's not, and you'll hear say this a lot during these discussions, but there's really not one size fits all, even with fees. It's a combination of how that advisor wants to work and what you are wanting to get out of the relationship. Yeah. So if you're just wanting to buy a mutual fund and one mutual fund and put your money in there, and that advisor's willing to do that in the relationship, then the old school commission might be the best setup for you, because that'll probably be the least expensive over time. But, of course, there's other ways you could go about that, but if you're wanting an ongoing advising relationship, I feel like, and most people do feel like that, kind of a pro rata pay as you go. If I do well for my client, then they want to continue to pay me. Right. Is a good setup.
Right. I agree. And at the end of the day, if cost is just straight up a concern for individuals, then they may want to go to a low fee robo advisor, just where they're just on the computer, or an online planning service like. That may be the best option for them. So it has to be a working relationship, and we'll talk about that a little bit more of how we approach the process of from the time we meet someone for the first time to bringing them on to a client, what that looks like. But but that leads me to another thing. We just talked about the advisory fee, but there may be some ancillary expenses as well, and it's appropriate to ask what are my all-in costs, because in addition to paying the advisors, you are also going to face. You want to know some other fees that may be out there. Meaning, well, am I going to have to pay any trading fees or ticket charges, or if I ask for planning, is that some assistance with tax, proactive tax planning, or assistance with estate planning or protection strategies? Are those encompassed in that advisory fee, or am I going to be charged extra? We've seen that in cases, I think, and that's all should be asked ahead of time.
Yeah, and it's like I say, everybody. It's just like any other business out there. Now there are rules and guidelines that have to be followed, and every advisor, if they're doing it within the rules, have to work within that framework. But as a independent advisor, especially, you're able to kind of construct your business how you want it and how you think is best for your customers. And sometimes it could be a combination of that, but within that is also the products you sell. And those products have costs, and there's new products being developed all the time in the financial world.
It's amazing.
And they all have different types of internal costs, and those costs are most of the time valid in that, there's behind the scenes work being done. For example, a mutual fund, and maybe a good show at some point would be to talk about how the different products like funds and that kind of thing work a little more. But there's a manager that runs that mutual fund, and he has to be paid somehow, and there's trading costs within that. And so that cost is passed on, plus his paycheck, basically, and the company that he works for's profit is passed on to the investor. And that's not necessarily shown in the compensation that the advisor is paid.
Correct.
So, we do a pretty good job, I feel like, of laying all that out for our customers and letting them know what all's involved and what their potential gain or loss is in that product, which is really what they're there for.
Exactly. Gaining. And I think that we could have a long discussion about all the ancillary fees, but one thing we do pride ourselves on is being extremely transparent with those, and I think that would be appropriate for any individual if you're working with them. It's just, hey, I mean, you should know. Nobody should be ashamed. I mean, there's always expenses involved. It doesn't matter if it's no load or, there's always a fee. And even if people don't think there is, if you dive into it enough, there always is. But it's appropriate. We think being transparent about it, it's better to have that discussion up front than we don't like surprises.
And if you don't feel like you're getting the right information from someone, first of all, you shouldn't you go forward if you don't feel like you're getting transparent information. But with almost every valid investment product out there, there is a legal document that shows all the expenses inside of it. And now whether you can sift through all those 100 pages of information that the prospectus has, but that'll tell you, and you can find those online, or usually you should get it in paper form if you request that as well.
Right, and that's all that is establishing as we go on to our next question here. That taking all these things into consideration is what type of value are you looking for, and what type of value do you think you're going to receive by going into a relationship with someone? And how's that? So how will a relationship work is something else to talk about, not just performance fees and stuff. But how much access are you going to have to the advisor? And
that's really, kind of to back up a step, I think value is a key word. When you're talking about hiring somebody to work alongside you, you're not just paying for a performance return, unless that's all your relationship is.
And that should be disclosed up front. I know that's not we don't feel that's going to be a good working relationship for us with clients. We want to help our clients make money. I know, but we'll talk about this a little bit further. I mean, there's more to it in terms
sure.
of what value we bring to the table.
Right.
Now, value's a two-way street. The client, it may not be a good match if it's not seeing that all-encompassed value.
Right. Well, I mean, my parents, they need guidance on how to make their money last, how to make sure that they're not paying too much taxes when they withdraw money out of their retirement accounts. And they don't necessarily need to grow their money because they've done that. But, you know, someone like you or me, we're not at that stage in life, you know. So they can't put the same value on services as you know, the different stages. So that, you know, how that relationship works ties right into that values. That's where I'm headed with that.
Right. And then, you know, so you'd want to know ahead of time, you know, how often are you going to meet with the individual you're going to be working with, and whether they're available for phone calls or emails outside of those designated time periods. I know that we like to try to set up ourselves with our clients so that they know when we start a relationship how many times we're going to try to meet each year with them. But then we also sprinkle in some phone calls ancillary. Now, obviously, if we meet with them in March and aren't supposed to until November,
Right.
Then if something comes up in July, we're going to call them.
Right.
So it's not that rigid and stringent, but it is important in entering a relationship that you know how much access you have.
Right. And everybody does that different. Every advisor works differently with that, and that's a system that they put in place that they feel like, you know, is either right for them or right for the client, and hopefully it's right for both, or it's not going to work very well. But you know, I was out at an event, a family event the other day, and someone came up to me and said, you know, they wanted to come talk to us, and said, I've tried to reach out to my guy 5 times over the last year, and I haven't gotten a return call yet. Yeah. You know, who knows why, but we feel like it's a part of our duty and our job, and we also feel like it's a good way to keep our clients happy, to be available at a reasonable time period. Now, you know, it's not often that I field calls, you know, at 11 o'clock at night from a client. I mean, I'm not saying I wouldn't, but I'd probably prefer not to, you know. But, you know, I think I can find a time sometime during a year that I can speak with somebody. So
that's right. So, and that, you know, that leads us, you know, everybody wants to talk, it all comes back to managing the investments, but is the investment, you know, what's the investment philosophy of the individual you're talking about? That's another good question to ask. And, you know, you have to believe in what that person's saying, or it's not going to be a good experience. I always try to use what I say is we try to help people not be average.
Right.
The average investor buys high and sells low. We've had a great, as we film this right now and record this, we're here, and we just came off a rough month of September 2021. But before that, we'd had, I wouldn't say unprecedented, but we'd had a significant period of time of low volatility in the market. And the market was going up. So all of a sudden, you know, short memories come about when you get statements and all of a sudden there's a slight pullback.
Right.
Hey, what's going on in the market? You know, nobody's been paying attention for a while, but it's just a blip, you know, in mean times. But you got to, the way we feel to keep individuals from being average investors is to communicate so that they know what the potential to the upside is, but also if there's a rough time in the market, and we're going to see a rough time in the market always. I mean, not always, but I mean, consistently through cycles.
There's always pullbacks, and
I think the stats is 28%. There's a down year, 28% chance there's going to be a down year, 72% chance it's usually up. But that helps individuals not buy high and sell low, or get out when the market turns down, I feel. Is that?
Yeah, you know, and there's other things without getting too much into the weeds, but, you know, is your advisor an aggressive type of investor? And if so, you need to know that, and that may be exactly what you need. Or are they, you know, is their main focus on making sure that you have safe money, And when we say that means different things to different people, and you need to know what it means for you. But, are you at the stage of your life that you need to make sure the money versus taking some volatility to help it grow, you need to make sure that volatility is lessened a little bit so that, you're able to access your money better and things like that and some people are good at both, but you need to know how they do that. And a good advisor will be able to explain that in a fairly detailed manner on how they can do it.
Yeah.
So
that's good. So in this day and time, we always want to, you always want to make sure you ask who's the custodian. In our case, that's an easy answer. Our back office, LPL Financial. But ideally, your financial advisor has hired an independent custodian, and such as ourselves, such as a brokerage, or in that place, the custodian is where the assets are held, where the money's held.
Right.
And it's totally separate of the advisor you're working with and their firm, and even their back office. It's held in trust. Inside of that, the account's held at the custodian, and the only reason the account should go up or down is because of the investments inside of it.
That's right.
And that, I've got my notes here, but rather than acting as their own custodian, and there was one very popular person who served as their own custodian, and that was Bernie Madoff, the notorious financial advisor who defrauded clients in a multi-billion-dollar Ponzi scheme. But he was serving as his own custodian, not using an independent custodian, and so the custodian provides an important safety check.
Yeah, and that's where the accounting for your debits and credits and that kind of thing take place. As you make money, it helps. That's where you are able to, through math, find your performance, and if you don't have that, and they're under a whole nother level of scrutiny, outside of what the financial advisor is, from several organizations. And if you don't have that in place, that means somebody is, in their back corner office, doing their own math for you. And, that's where people have ran into problems. Bernie's not the only person that there's been hundreds and hundreds of people. So do some background check, ask some questions, get some documentation.
Make sure you can go online.
Right.
And have the ability to go online and check your account's performance. If they're reputable, they're going to have online access, so you can go online any minute and double check.
99% of the guys like us that are out there are doing it the right way, and the custodians are reputable. Now, there are some custodians that are better than others, and through trial and error and asking people. But at the end of the day, most of the reputable custodians out there do it the right way. Exactly. It's just a matter of whether their features fit what the advisor and the client need.
Yeah, and from the client standpoint, you got to just ask that question.
Right.
It's not knowing all the details necessarily,
right.
Just making sure it's a reputable one. Now, the kind of last question we'll cover today is one we don't necessarily need to get in the weeds about, and that's as that advisor you're interviewing, are they gonna consider taxes and tax implications? Once again, we're not a CPA, but we feel it's extremely important that we feel by having a knowledge of tax code and the ramifications of certain moves, you're able to head off some tax implications out there. It's very important to be knowledgeable about that.
For sure, and you're not, when you say that, people think, well, maybe Ryan's got an offshore account or something. Yeah. He can hide my money from being taxed in. That's not the case. You want to use the tax code to the full benefit for yourself. So pay all the taxes that are due for you, but don't pay more than you have to, right?
Such things as offsetting gains with any losses you may have in the account for those accounts that are not retirement accounts, non-qualified assets. Make sure that an advisor is just not going in and blindly selling.
Right.
Are they putting the right types of investments in the right types of accounts? Are you going to have a tax efficient drawdown strategy once you have to tap into your funds in retirement? All those are things to consider.
Right.
If they're not, at least considering that, then that should be a potential red flag.
And if you have investments and are just, you decide to move to a new advisor, you need to ask what their plan is for avoiding taxes as that account moves over. Sometimes there aren't taxes, but sometimes we've seen some horror stories where, people have had nice gains and just reinvested the whole thing because that's what the advisor liked to do, and there wasn't much thought put to the taxes, and it turned out to be a big bill for them. The other thing is, think about the long-term benefit or cost tax-wise to the investment you're making. There's certain vehicles out there that do a really good job of kind of having a tax-sheltered vehicle where the taxes are delayed until you withdraw money out of the account, but they're really high taxes at that point.
Right.
Not necessarily a bad vehicle, but it could be bad for the wrong situation.
Right, exactly.
Exactly. So, if the advisor does not at least bring up, and not everybody needs very high level tax work, but if the advisor is not talking about why that's important in your relationship, then make sure that that's not something you need. I'm not saying that you do, but it should at least be considered. And in fact, most people, we ask to see their recent tax return, and we can quickly review that. And we're not telling them how to do their taxes, but we can tell if they're taking full advantage with their investments for the tax code to be, in their favor, making the most of it.
So we pride ourselves in staying up to speed on that. Any tax law changes, there's certainly going to be some to come here as we film this and throughout the rest of the year.
That's right. They're changing all the time. You need to work closely with your advisors and your accountant or your CPAs and make sure that they're up to date and you're up to date on that.
So as we wrap up today, I just wanted to kind of summarize what we've talked about. We've covered a number of different questions, obviously, but let's also kind of talk about our process and maybe and that process. We feel it's truly an interview for the potential client as well as us.
Right, because everybody doesn't have a fit for us, and I don't think if we're anybody, in my opinion, and this is me just talking, but if you have a strong belief in what you're doing, then you do things a certain way, and that doesn't fit everybody's bucket. But we're willing to go through the process to find out.
We offer a complimentary financial checkup, and at that time, it's a first interview where we're getting to know each other, collecting information, fielding questions, much like what we're telling people that they should ask. Or many times we cover it ahead of time. Right. Those items so that we're heading off some questions that they may have to make sure we're being transparent. And so usually that first interview would also involve a pretty rigorous data collection, trying to get a feel for the number of accounts, the type of accounts, the amount of assets we're talking about, where they're held.
And their expectations as well.
And their expectations and goals. And that from our side is also important for us to know, because from our side, if a client or a prospect has unrealistic expectations, we can talk through that and explain to them. Yeah,
most of the time it's an educational
process. Exactly. That's a great point. But there has been some times where we just feel like it's not going to be a good mesh because we know what the market, and we think we'd have to maybe be outside our comfort zone and our standard operating procedures in taking that individual on.
Right. If it's something that we feel is not doable or is outside of the risk parameters that we feel the client should have, we are responsible to let that client know that we don't feel comfortable doing this. And if someone takes on more than they can chew, basically, at some point somebody's going to be disappointed along the way. It's either going to be the client or the advisor, and the transparency thing goes right into that, knowing what your fee is, us knowing that you're comfortable with that fee and see value in that fee, because, you know, the advisor can only do what they can do. And if you don't see value in it, it's going to be a pretty miserable relationship along the way.
It is.
So.
I agree. So that, you know, that interview process, and we usually follow up that first appointment with a second appointment, where we sit back, we take some time after that first appointment to assess the individual's situation. It gives them time to kind of come back to us with any questions, but then we get back together and we put together a list of items to discuss. And from that standpoint, it really is seeing if, you know, evaluating if there's value there from both sides, and is it a good working relationship. And usually we move more times than not, because we work off referrals.
Sure.
In many cases, it's a working relationship and we move forward, but we want to make sure we're covering dotting I's and crosses the T's each time. So we don't really stray from that procedure. So I think it's important.
Yeah, and one thing I really like about our process is that over time we have developed a process that helps not only find what somebody wants, but we've also developed services that meet like I say, we're not right for everybody, but we have services that meet people at different stages of their investment and planning process. And
because most of our, as it says, we're working with a retirement plan. We're helping people work towards retirement in most cases.
Right.
And the vast majority of assets we manage are those for pre-retirees and retirees. However, we got a large number of individuals that are younger, that are looking to put forth that solid foundation for themselves. They may not have that much assets, but they need some things. And talk about that, what we have in place, those services.
Well, I mean, you know, and I think we kind of developed this through just kind of looking at our trials and errors through our lives. And if we could go back and work with somebody that could give us some good guidance, that's very helpful. So, you know, we have a plan called the early entrant planning process, and it's a plan for a fee. It can be a monthly or an annual fee.
Like a
subscription type service. And you get a certain amount of, you know, better than basic planning, but you also get access to having us, you know, guide you through certain things and also help you get your first steps in investing, you know, when you're ready for that. But a lot of people, you know, especially people that are early in their careers or people that have never invested, just don't know how to go about that. And, you know, information like this podcast that we've gone over, they're not even sure how to do that, but much less, you know, go on a robo website or you know, and start up their investment plan and feel confident about it. So, you know, that's really what we try to do with that, is give you access to a financial planner, even though, you know, a lot of times you may not have what the minimum requirement is that you'll run into at a lot of places to invest. This gives you a way to start your investment journey and be, you know, work toward being successful with it.
So if you're out there listening and have questions about that, the early entrant plan, or anything else that we spoke about today, don't hesitate to call our office.
Right.
I mentioned earlier the website. That's a great way to interact with us as well if you don't have our phone number. But our phone number is 828-855-2067, or you can find us at seretirementplanners.com. We really appreciate you listening today. We appreciate the opportunity to assist our clients, but also those individuals that they feel like they need somebody to talk to.
Yeah.
And we'd love for you to give us a call and start that process. So
for sure. And we hope this was helpful info.
Yeah. Thanks for listening today. We'll look forward to you join us again. Thank you.
Securities and advisory services offered through LPL Financial, a registered investment advisor. Member of FINRA, SIPC. Southeast Retirement Planners is not affiliated with LPL Financial or registered as a broker-dealer or investment advisor.